Brought to you by Thomas Allgaier and Frennis. This edition highlights key LinkedIn posts on future mobility and market evolution in weeks 7 and 8. Frennis supports enterprises with market and competitive intelligence, decoding disruptive technologies, customer needs, regulatory change, and competitive moves so product teams and strategy leaders don't just react, but shape the future of mobility.
Which is quite the mission statement to live up to.
It is, yeah. But honestly, looking at the feed for this deep dive, weeks 7 and 8 of 2026 shaping the future feels a lot less like science fiction right now and a lot more like just really heavy logistics.
Yeah, it really does. That's exactly the vibe. It feels like the whole industry kind of woke up with a hangover from this massive cool tech party, right?
Right.
And suddenly they're realizing, oh, wait, we have to actually operate these businesses in the real world.
Exactly. I mean, the posts we're seeing this cycle, they aren't about the next shiny sensor or some crazy AI breakthrough. They're about, well, broken doors.
Rain delays.
Yeah, rain delays and bankruptcy filings. It's a very different conversation.
It's the boring era of mobility. And I actually mean that as a compliment. We are finally talking about unit economics and operational bottlenecks instead of just looking at concept art.
Well, let's test that compliment theory, because some of this reality check is actually pretty painful. We have to start with this story Josh Ornstein shared. On the surface, it sounds like a joke.
Oh, the Waymo door thing.
Yes, the open door problem. But when you dig into the P&L impact, it's a total disaster.
It really is.
So just to give you some context, we have a Waymo Robotaxi. This is a vehicle estimated to cost around $200,000, right?
At least.
And it is arguably the most sophisticated artificial intelligence currently deployed in the physical world. It navigates San Francisco traffic, it avoids pedestrians, predicts movement.
But if a passenger gets out and leaves the door slightly ajar,
the car is bricked.
Completely bricked. It creates this critical error state, and the car literally cannot move.
Right. And because the car doesn't have the hardware to just, close its own door, Waymo is resorting to gig labor. Ornstein pointed out they are using the Honk app or even DoorDash drivers and paying them up to $24 just to drive over to the vehicle and shut the door.
Which is hilarious until you do the math on the unit economics.
Exactly. I was trying to run the numbers on this. Say an average Robotaxi ride is, $15 to $20 in revenue?
Give or take, yeah.
If you have to pay a gig worker $24 to fix a simple user error, you haven't just lost the profit on that one trip.
No, you've wiped out the margin for the next 3 or 4 trips, easily.
And that's not even factoring in the opportunity cost. The car is sitting idle for 20 minutes waiting for the quote-unquote door closer to arrive.
It's a perfect example of how the industry completely overlooked the physical interface while obsessing over the digital one. Ornstein made this really cutting observation. He said, Honda figured out power sliding doors in 1999.
1999.
Right, it's a solved problem. But the AV industry was just so obsessed with the brain, the LiDAR, the compute, that they entirely forgot the body.
And this isn't just a quirky Waymo design flaw. It's a systemic issue. Federico Raniero weighed in on this exact thing, and he argues this is actually the main bottleneck for the entire sector right now. It all comes down to uptime.
Yeah, Raniero's point is crucial. We're moving into a phase where the software is, frankly, mostly good enough.
Right.
But the physical operations are dragging down the ROI. If you have a fleet of 5,000 cars, you need a massive, flexible workforce just to charge them, clean them, and yes, close the doors. You can't scale that with full-time software engineers.
Which connects directly to what Augustin Friedel posted.
Yeah.
He coined this phrase that I think perfectly frames this whole deep dive. He called it winner takes ops.
Winner takes ops. I love that. It's such a great pivot from the old Silicon Valley winner takes all mentality, which was always just based on who raised the most capital.
Or who had the coolest algorithm.
Exactly. Friedel is saying that capital isn't the moat anymore. Everyone has access to good sensors now. The real moat is, can you build a depot? Can you clean a spilled coffee out of the back seat in 10 minutes so the car can get back on the road and generate revenue?
It sounds so mundane. But if you can't do that, you don't have a business. You just have a very expensive science project. And looking at the landscape, it seems like Waymo and Tesla are taking two very diametrically opposed approaches to solving this winner-takes-ops challenge.
Oh, completely. Waymo is basically trying to engineer their way out of it with better hardware. We saw those posts from Eddie M. and Ilya Segalovich about Waymo's 6th-generation system.
Right, the new sensor suite.
Yeah, they are investing heavily, like $27 billion heavily to drive the sensor costs down. They've got the suite under $20,000 now, which is half of the previous generation.
That's a huge drop. But they are still relying on a very hardware-heavy, expensive vehicle to guarantee what they call family travel safety.
Contrast that with Tesla.
Oh, boy. Yeah. We had the data from Johnny Liu and Alexander Lubushin, and frankly, the gap between the Tesla narrative and the actual operational data is getting really uncomfortable.
Uncomfortable is definitely a polite way to put it. The narrative is, unsupervised, FSD, full self-driving. But Lubushin pulled the NHTSA data from Austin, and the crash rates are honestly alarming. Tesla robotaxis are crashing 4 times more often than human drivers.
4 times more, and 8 times more than the national average.
That is the statistic that just stops you in your tracks. If you are a regulator or an insurance company, how do you even underwrite that risk? James Sampson added more context to the Austin rollout specifically. Service availability was only around 19%.
19%? So 4 out of 5 times you actually want a car, you can't even get one.
Basically. Because of rain or fog or just the system hesitating. Sampson points out that the gap between Tesla's stock valuation, which basically assumes they've completely solved autonomy, and the operational reality of a car that can't handle a foggy morning in Texas, it's just widening by the day.
It really brings up the liability question, too. If they are pushing this unsupervised angle, but the car crashes 4 times more than a human, who is liable? Is it the owner? Is it Tesla? It feels like they are pushing the operational complexity onto the user, whereas Waymo is trying to internalize it.
Even if it's expensive.
Exactly. And we actually got a really interesting user perspective on that contrast. Leonid Tsarenko posted about taking a Tesla Robotaxi in San Francisco. He noted it was definitely cheaper than Waymo, which makes sense given the cheaper hardware.
Yeah.
But it still had a safety driver in the front seat, and it dropped him off early because the road ahead was blocked and it just couldn't figure out a reroute.
Wow. Meanwhile, Nico Rosberg, who, being a former F1 champion, knows a thing or two about driving, he took a Waymo and SF. He was totally alone, doing work in the back, and he called the experience normal.
And in this industry, normal is the holy grail.
Boring is good. If it's boring, it works. Rosberg also threw in a quick side note about Germany, pointing out that regulations there are still forcing companies like they to use teledriving instead of full autonomy.
Teledriving is fascinating. It's almost like admitting defeat on the AI front, at least temporarily. It says the robot can't do it perfectly, so let's just put a human in a simulator 50 miles away to drive the car over a 5G network.
It's a regulatory patch. But, while the West is endlessly arguing about teledriving versus full autonomy versus open doors, the Middle East and China are playing a completely different game. Which leads us to the second major theme from the week's 7 and 8 posts.
The global divergence. The updates out of the UAE were really striking. We saw a post from Peggy Van de Plash and Yuri Demansky about Abu Dhabi. They aren't just running cute little pilots over there. They are running commercial services with Uber and WeRide.
And the vibe is totally different. It's not a scrappy startup trying to move fast and break things. It's an infrastructure vibe.
Demansky called it methodical, and I think that's the key word. In the U.S., companies are trying to build robots that can survive on chaotic, human-centric roads. In the UAE, they're building the roads and the regulations to specifically accommodate the robots. It's an infrastructure-first approach.
But there is a darker, or at least a much more complex economic layer here that Jamie Lane uncovered in his post.
Right.
In the U.S., the whole business case for robotaxis is basically drivers are expensive, robots are cheap. But in the UAE, drivers are often very low-wage immigrant labor. They're already cheap. So Lane asks, does the unit economics argument actually hold up there?
That is such a brilliant question. If you replace a low-wage worker with a highly complex, high-maintenance robotic vehicle, are you actually saving any money? Lane connects this to the broader ecosystem. You have a tech company in Guangzhou supplying the cars, maybe using IP from a collapsed startup in San Francisco, and then you have 70,000 migrant workers whose entire livelihoods depend on driving jobs.
So the efficiency they're chasing might actually be more about political goals or tech supremacy rather than pure profit margin. It really challenges the automatic assumption that automation is always the cheaper path.
It really does. But there is one area where automation is undeniably winning on the profit front, And we almost completely ignore it because it doesn't carry human passengers.
Logistics.
Yes. Ben Hubbard's post about Neolix. This absolutely blew my mind. I feel like we never hear about Neolix in the mainstream, but Hubbard says they have 16,000 RoboVans deployed globally right now.
16,000. It's wild. While everyone else is debating whether a Tesla can handle a simple roundabout, Neolix is just quietly moving goods across China and other markets, and they are actually profitable in certain sectors.
Why is that? Is their tech somehow vastly superior?
No, the operational reality is just so much simpler. Think about it. A box of vegetables doesn't complain if the car brakes too hard.
It doesn't leave the door open.
Exactly. It doesn't leave the door open. It doesn't sue you if you get into a minor fender bender. Abdullah made a very similar argument regarding autonomous trucks. He believes trucks are going to scale way before urban robotaxis ever do because the environment, mostly highways, is simpler and the utilization is 24/7.
That makes perfect sense. The operational constraints are just so much lower. But when you try to bring that same tech into highly complex urban environments, the friction spikes immediately. Natalie Lung reported that New York Governor Hochul just halted a proposal for robotaxi expansion outside of NYC.
A huge regulatory headwind for the West. And contrast that approach with Hamburg. Unjust Jarks posted about Hamburg taking a partnership approach with Free Nows. They aren't just letting robotaxis run wild to disrupt everything. They are actively integrating autonomous taxis into the existing public transport network.
That feels like the mature approach. Instead of disruption, it's integration. And speaking of maturity, we really need to pivot to micromobility, because if robotaxis are currently in their awkward teenage years, it feels like scooters and e-bikes are finally entering adulthood.
Well, some of them are. The divergence between the winners and losers in micromobility right now is incredibly stark.
Very true. On the winner side, we have Voy technology. Matthias Hermansen and Praven Joel Jones posted their 2025 numbers, and they are impressive. Revenue is up 34%, and adjusted EBITDA is up 70%.
Positive EBITDA in shared micromobility is a massive achievement. I mean, for years, the primary criticism was that these business models were fundamentally broken, that the scooters broke too fast to ever pay back their initial unit cost. But Voy seems to have actually solved the winner-takes-ops puzzle.
How did they do it, though? Did they just massively raise prices on the user?
Not exactly. They shifted from being a quote-unquote scooter company to being a partner to cities. They secured long-term contracts, they drastically improved vehicle durability, and they optimized that fleet rebalancing we were talking about earlier. They essentially stopped treating it like a hypergrowth tech play and started treating it like a public utility.
Which is such a contrast to Rad Power Bikes. Horace Didier reported that they just filed for Chapter 11 bankruptcy, and they sold for just $13.2 million. This is a company that used to be a unicorn.
It highlights the brutal difference between the service model and the hardware sales model. Rad Power was selling e-bikes directly to consumers. That's a tough business. Margins are razor thin, sitting on inventory kills your cash flow, and once everyone who wants an e-bike has bought one, your growth just stalls out. Voy is selling the ride itself, which is recurring revenue.
True, but even the service model has its own operational kryptonite. Enzo Lanoux posted about the weather situation in France. Apparently, extreme heavy rains wiped out millions in revenue in just 46 days.
Millions. And this exposes the core fragility of the model. If it rains, utilization instantly drops 50 to 80%. But your fixed costs, the warehouse rent, the mechanic salaries, the insurance one now, those stay exactly the same. You can have the best app interface in the world, but you can't code away the rain.
So true. Thomas Broughton raised another massive operational headache: parking. He called it the broken circle.
This is the user behavior problem all over again. If the user doesn't park the scooter correctly, the city fines the operator, not the user. Broughton points out that the parking verification tech is still really hit or miss. It's another example where the tech is 90% there, but that last 10%, just verifying that the kickstand is down in the right spot, can destroy the entire business model.
The solution to that seems cultural, or at least structural. Kirsten Heineke's post about Japan was really eye-opening. He describes a utility-first culture over there.
Japan is fascinating because they don't view cycling as some sort of micro-mobility disruption. It's just how you get to the train. Heineke noted that 57% of cyclists in Tokyo are women, often using those Momatari bikes for shopping or carrying kids. It's not about sport or performance like it often is in the West. It's fully integrated into the rail network.
And we saw that exact same integration theme popping up in Switzerland. Alexander Klimt and Manuel Herzog posted about the city of Biel selecting Voi for safety and order. But the bigger news was OS Winane offering a 25% discount on dot rides if you already hold a season train ticket.
That is the magic bullet right there. True integration. When the scooter is just viewed as an extension of the train ticket, you solve your demand problem. You aren't fighting for net new customers, you are just inheriting them directly from the train system for that last mile.
Which bleeds perfectly into our final theme, shared mobility and urban design. Because if we are successfully integrating these things, it actually changes the physical shape of the city.
It does. Gunnar Nurki dropped a stat that shows this is happening at scale. Car-sharing parking spaces in public areas have gone up 498% since 2018.
Wow, that is a massive reclaiming of public land.
It really is. The working logic is that one shared car replaces about 10 private cars. So you are trading one dedicated parking spot for 9 spots worth of open space or new bike lanes or even housing.
But Brent van der Heijden reminds us that making that trade actually work is, again, an ops nightmare. He calls it orchestrating supply.
Because demand isn't flat. Everyone wants a shared car at 5:00 p.m. on a Friday. Nobody wants one at 3 a.m. on a Tuesday. Managing those peak spikes without having thousands of expensive cars sitting idle is a logistical high-wire act.
Proximus is trying to force that behavior change from the corporate side. Dorian Drogfil share their new company policy, and it's bold. Parking is no longer an entitlement.
I love this policy. They gave their employees a mobility budget. You can spend it on a parking spot at the office if you really want to drive. But if you bike or take the train, you get to keep that money for other things. It turns parking from a right into a product. And when you put a price tag on it, people start making very different choices.
And Lars Christian Gruden Olsen points out that people are already making different choices because the traditional commuter is dead.
The 9-to-5, Tuesday through Thursday commuter is an endangered species thanks to hybrid work. The growth in public transport usage is now coming from leisure and social trips, not the morning grind. That completely changes how cities need to plan transit. We don't need to optimize purely for rush hour anymore. We need to optimize for all-day flexibility.
Which brings us to the geometry problem. Damien Yao posted about the Auckland Harbor Bridge debate. They were fighting over a $9 toll, and Yao basically stepped in and said, "You're all asking the wrong question."
He argued for lane reallocation instead. It's pure math. A general traffic lane moves about 3,000 people an hour, maximum. A dedicated bus lane moves 12,000. If you have a bridge with strictly limited physical space, why are you prioritizing the least geometrically efficient mode of transport? It's not about inventing new tech. It's about having the political courage to reallocate the concrete we already have.
So looking back at all the posts from these 2 weeks, we have $200,000 robots being defeated by open doors. We have scooters becoming profitable by acting more like trains, and cities realizing that a bucket of paint to redesign a lane might be more powerful than a new app.
It all comes back to that boring era theme. The core technology is here. It works, mostly. But the companies that are actually winning in 2026 aren't the ones with the flashiest demo video. They are the ones mastering the mundane things. Closing doors, cleaning cars, integrating with train schedules, and managing the P&L of a rainy Tuesday.
Operations is the new strategy.
Exactly. And here is a final thought for you to take away. We've talked a lot today about efficiency, optimization, and algorithms deciding routes and rebalancing fleets. But as we move toward this fully orchestrated mobility, where an algorithm decides if a car is available, what the surge price is, and where it goes, we are quietly handing over the basic right to move.
Right.
If the algorithm decides a certain neighborhood just isn't profitable to serve because of quote-unquote operational reality, what happens to the people who live there? Do we accidentally create algorithmic mobility deserts just because the ops are too hard?
That is the hidden cost of the winner-takes-ops model.
Yeah.
Who actually defines the parameters of that algorithm?
Who owns the logic of our logistics?
A great question to end on. If you enjoyed this episode, new episodes drop every 2 weeks. Also check out our other editions on electrification and battery technology, next-gen vehicle intelligence, and commercial fleet insights.
Thanks for joining us.
Thanks for listening, and don't forget to subscribe so you never miss a deep dive.